So if you're an investor and want to push off all those taxes when you sell a property, you're in the right podcast today. We're talking about 1031 exchanges. We have a powerhouse in the industry coming in today. We're excited to have it again. It's Kandas Myer. And I heard that you just came out of retirement for this podcast.
I just came out of retirement for this specific podcast, and that's right.
That's what I was hoping for. So Candace just actually did come out of retirement, correct?
I did. I thought I was going to retire and ended up getting headhunted for the third time, and this company had all the right answers.
What company is it?
1031 Specialists.
Okay, so it's a national company.
National.
Okay. But you're like 2 weeks into it, right? You're still getting
2 weeks into it, so getting my legs on with the new company. But I've been in 1031 exchange development and facilitation for 28 years.
Okay,
so
yeah, because I remember you being around.
Yeah.
I think we've done some deals way back.
Yeah.
But she's back, and she is the one you want to talk to about 1031 exchanges. And it's called the intermediary. Is that correct?
Yeah, Qualified Intermediary is the function of the company.
Okay.
And I help to counsel and structure and do the strategy on getting the deal to look, walk, and quack.
Okay.
There's lots of federal rules that you got to follow.
Yes. Yeah. So that's what we're going to talk about today. So you're in the right podcast. If you're an investor and are thinking about moving properties, you want to. So please like our videos, subscribe, and send this to another investor. I'm an investor, so I want to hear all about it. So I have a list of questions. It's the top 15 questions that we're asking today. So you ready?
We'll get through as many as we can.
All right. So talking about 1031s, how many have you facilitated, and what types of properties have you handled?
Oh my goodness. Okay, so I have facilitated thousands and thousands because I began in 1997.
Wow.
And so I just literally thousands. I recently got a client from an agent, and the client said to me, "Oh, I think you did our exchange 8 years ago." And sure enough, when I pulled up some information on my computer, there they were.
Yep.
So yeah, I've been doing it a long time, and so it's thousands and thousands of completed exchanges.
What's the most expensive exchange you've done?
$192 million. That was a commercial deal coming out of Las Vegas.
And then they bought where?
Well, they bought in Las Vegas, but they changed from what they were buying. They bought about 10 different kinds of properties in exchange for the one property that was $192 million.
So that's what we all hope for, right?
Well, that was a big one, but the smallest one I know was a $10,000 vacant lot in Texas that he sold and exchanged into Nevada.
Okay, so they're all over the map. So let's hop in. Take a drink, no problem. Let's talk about what is a 1031 exchange from the 40,000 foot level, and then why should investors consider it?
Well, the 1031 is a federal tax code, so it applies everywhere in the nation. It also applies in the U.S. Guam territory and the U.S. Virgin Islands.
Okay.
So it is a tax code that applies for every single state plus those two territories. And what it does is it enables an investor to sell one investment property as long as they're going to buy another investment property of equal or greater value.
Okay.
And they won't have to pay the capital gains tax, but there's a whole pathway that has to follow.
Okay.
And that is what I help to generate and put together.
So, but you actually counsel, so if you have a seller saying, "Hey, I'm going to sell this property. I want to use Candace." You're qualified. You're in the business of, hey, this is the things you have to do. So then when they hire you and pay the fee, correct? That's what the service they're getting. Is that right? The
qualified intermediary is going to be working the documents through the closing. So they have they're going to work with the closing agent. Like normally out west here, that's the title and escrow. Midwest, it's usually an attorney. Eastern Seaboard, it's usually an attorney.
Okay.
So whoever the closing agent is, that's who the qualified intermediary works with. What I do is I structure and counsel and make sure that the whole shebang is the proper structure to be a 1031 exchange.
So you don't get when you do your taxes next year.
Right.
And we always encourage you to talk to your accountant, CPA.
Your CPA or your tax
They
attorney.
have to be tied into this, right?
Right. And I'm more than willing to talk with them as well, because sometimes the tax attorney and the CPA, they're not necessarily versed in 1031. They might be versed in other areas, which doesn't mean anything poor about them.
Right.
It simply means that this is an obscure area of U.S. tax code that pertains particularly to real estate.
Okay. So let's talk about what are the key timelines for the exchange, particularly regarding the 45-day identification period and the 180-day rule, because these are hard and fast rules, correct?
They are. They're written in stone, and I like to say it's the same stone the 10 Commandments were written on.
Wow.
It is. The feds are saying, once you sell that property, and you do have to have the qualified intermediary involved with the escrow before it closes. Once you close it, you have a 45-day window to identify in writing what you're going to buy. You have, from that same closing date, a 180-day window to actually close. Don't need to take all 180 days, but when that 45-day ends, if you have not identified something in writing to the intermediary, your exchange is over and you owe the tax. We can't fight that.
Okay, so I have questions about this.
Absolutely.
So
Yeah.
you close, you can't just take the money to the title company that you're currently using. You have to have a specialized 1031
Account.
by law, right? This is a law.
Federal law. You can't touch the money.
You can't ever have it
Yeah.
delivered to you, and it has to go from title company transferred to your account, right?
To a qualified intermediary that is holding an account for you, the exchanger.
Okay.
And let's talk about that for a minute, because this is where the qualified intermediary is very important. How are those accounts held? They
Yes.
need to be segregated. Each exchanger has their own account. That's number one.
Yep.
Number two, qualified escrow account. Okay, that doesn't mean it sits in escrow. It means your intermediary has an account that if they move the money, they have to have you, the exchanger's signature, in order to move the money from wherever they have put it. And if they put it in places other than a regular bank account, in other words, you don't want it invested in something that could lose principal.
Right.
Okay, it has to be safe, it has to be solid, hopefully FDIC insured where it's at, and only the exchanger's signature can move the money. You know, there's obviously the company has to have people that sign as well, but the exchanger's big safety feature is that. So qualified escrow accounts very important.
So in your account, in your escrow account, when you take someone's money from the proceeds from a sale,
When we,
so you get it from the title company, goes to you.
goes to the
Can
company,
it
not to
be,
me.
or not to you,
Yeah.
not personally, no,
Uh-huh,
to
yeah.
the 1031
To
specialist.
the exchange intermediary from the closer.
Can they have it in an account that makes money interest bearing?
Well, that's where the intermediaries make their money.
Okay.
They charge a minimal fee.
I was wondering where they get their.
Yeah, they do not charge very much. Like a regular exchange with our company is just $11.95. So they're not making a lot of money. Obviously, they've got to pay me, they've got to pay
Right.
the document prep, they've got to pay to have the qualified escrow account set up. It does cost extra money. Okay, so all of these things cost them more than their fee. So they're hopefully making money on the interest during that 45-day period or however long it takes you to close the replacement property. And that's every intermediary in the country.
So that's how, because I was always wondering,
Yeah, that's how they make their money.
$1,200
Yeah, right.
is, I mean, you'd have to do a lot of those to make money. I'm always looking at businesses trying to figure
Yep.
out, so I didn't know that, so
Yeah.
they're making money off
They
that.
all
You
make
can't,
money on the interest.
the person, you're just giving their money and parking it there and there.
Well, the exchanger cannot control directly the money. That is one of the federal rules, is the exchanger has to control through the intermediary.
Okay.
Yeah, you're going to release the money over here for this closing of the replacement property. Okay, so. Yeah.
So let's talk about, I'm not 100% sure, even though I've done a few of these, the 45-day requirement. So can you run me through that, what that means? Because there's a lot of questions like, I have to identify 3, and then, the market's hot, can be hot, right? Because if you're not on it, after 45 days, so what is you identify 3 and they have to close on 1, but what happens if you can't, or?
Gotcha.
What's the?
Okay, yeah, and this is kind of advice for the investor as well as for your real estate agent who is representing you. Okay, so how do you make sure that you want a backup property in case the one you really want doesn't work out.
Well, that's what I'm saying is then I'll cut you off when I got to say one thing is
Yeah.
things come up during an inspection.
That's the point.
Yeah, so if you're past that 45 days, you get a bad inspection.
That's why you want to identify a backup property during the 45-day window. Now, how do you do that in a really, really fast market? Okay, because I've been an investor before, and because I've done this for 28 years, my suggestion is,
Okay, this is good.
and it's only if you want to do it this way. Here's what I want, and I identify it in the 45-day window, but let's look at this second choice. If my first choice doesn't work, can I go to my second choice? Well, how do you keep the second choice available to you? You write an offer, you get the offer accepted with the contingency that my first choice doesn't close. Now, I'm going to know within 2 or 3 weeks whether that first choice is going to close or not, right? Because you can, the inspections, the appraisal, all the things that happen in a real estate transaction. What if number one goes, no more escrow?
Right.
Okay, now I move to number two. Well, how did I keep that one in place? How do I make that seller of the number two choice be willing to come back and say, oh, okay, here's my suggestion. Mr. Seller number two, I'd like to buy you if my first choice doesn't close. I will know within 14 days, or I will know within 20 days.
Yep.
Okay, and if I don't perform, you can keep all of my earnest money.
So the earnest money is hard.
So earnest money is your bargaining chip. It goes hard. Or I like to say, try to say half the earnest money, because you're trying to negotiate. Start with half, and if that isn't enough, okay, you can keep all of it.
So question, can that come out of the pot of money over here, or does that have to be additional money that comes from without the exchange?
It's better, especially on choice number two, that it comes from the exchanger themselves pot of money and not from the exchange proceeds. Because the exchange proceeds, if you pull money out and they don't get replaced, taxable.
Okay.
So, yeah.
All right. So
I say the number one choice, if you want to take that risk, great. But number two, bring it out of your own pocket so you don't get taxed on it in addition to them keeping it.
Okay.
And that's just one way.
Okay, and that's why we're not going to share all the
Tricks.
ins and outs. You have to. That's why you got to use her, right? You got to use us.
That's why you want to call.
So we want to help you if you're doing 1030, and there's more, but that's just one way.
Yeah.
So what happens if you get to the point where the market is slowed, luckily, but so you have to identify up to 3. Can you identify 10?
Well, they start getting the government.
IRS.
The government, the IRS, the tax codes. They want you to identify 1 to 3 without limitation.
Okay.
If you go beyond 3, they're now going to limit you to buying twice the value you gave up. That's rule number 2. To confuse things further, if you want to buy more than twice the value you gave up and you're identifying more than 3, they're going to make you buy all of them.
Wow.
Yeah,
Okay.
so they don't like over-identifying. They don't mind if you want 1 and you're identifying 3. That seems just fine.
Okay.
Okay, but once you go beyond 3, they start tightening the noose.
Okay.
Yeah.
All right. So we're moving on here. Question number 4. How has the definition of like property evolved since recent years, and what type of properties can be exchanged?
Like kind. Okay, so like kind was never as restrictive as most people thought. Like kind is real estate used in for income or investment.
Okay.
An investment at this point is in real estate is going to be raw land, because we can't have just a property that sits and doesn't get rented out. If it does, and it's an improved property, then it still has to have rental, and that has changed over the years since 2008.
Because didn't you be able to do airplanes and stuff at some
Yeah,
point?
we used to. We used to be able to do personal property,
Okay.
but we can't do that anymore since 2018.
Okay. So that was
And then one recent change,
Uh-oh.
2024, but it opened a door instead of closing one,
Okay.
and that was the ability to do a 1031 exchange on an option to purchase. Woohoo! So you get an option to purchase under agreement, and it goes up in value. You can 1031 exchange that option even without owning that property, which is
wow.
amazing. Yeah, just
That's a
helped.
little bit more complex.
It is, and that we'll see that mostly in the commercial world. The last one I counseled on that, they had bought the option in the $300,000 range. It was commercial, and they ended up at the end of holding on to this option, it was worth over $700,000.
But they never owned it.
They never
just had
owned
the
it.
right
They
to
just had
exercise
the
it.
option, and then in the course of time, like I said, 2024. That little window opened up, and now this person can exchange that option and actually buy, add money to it, tax free. And
So how does that come up? Does that come up a lot? Because
That
obviously enough to where they changed the code.
the first time in 28 years, and this was a CPA from Massachusetts who called me for counsel, and he had that transaction structured. And so I don't think it comes up very often, but it's a wonderful thing to know, especially for commercial transactions, because those kinds of things happen.
Wow.
And back in the day, I remember we had those storage units that were for sale in Mound House, I think it was. Those storage units, a bunch of people had options to purchase. And they went up in value because one of the commercial brokers thought it was valuable, so he bought some options to purchase on 10 of the units, and they tripled in value. And so he was able to sell those, but back then he had to pay the taxes.
Okay.
Today, he could have done that without a taxation and do a 1031 on all of those.
Wow.
So yeah.
Okay.
So cool stuff.
All right. So on to number 6. So we're on to number 6. I don't know. You might have to get another drink of water there. There's 15 here, Candace. So number 6 is, can you explain the concept? Oh wait, no, wrong one.
We're on number 5?
We're on number 5.
Oh, that won't do, Ken. That just won't
What
do.
are the current restrictions on exchanging personal property, and how do they affect investors?
Well, actually, we just answered that.
Yeah, so-
we can't exchange personal property any longer.
But they used to.
We used to be able to.
Okay, so
No
that's
sense
out.
talking about it.
And that was out in 2018.
2018.
Okay, so all right, number 6. Can you explain the concept of boot in the 1031 exchange and its tax implications? What is that?
Boot would be value that you did not exchange. So
Can we use an example? Like
easy,
I like to use
easy
1,000,
example.
100,000.
I sold an investment property for $500,000. I bought down in value at 400.
Okay.
Okay, so the difference between what I sold and what I bought is boot. And that boot is fully taxable to the exchanger. And unfortunately, it's not a simple rate. A lot of people think, oh, it's just 15%. It is not. Your depreciation recapture alone is at 25. And then if you after 200 and some odd thousand, there's another 3% that kicks in. And I mean, there's all these moving parts. And so what I tell people, if they're going to have boot in an exchange, make sure they talk to their accountant so they know how much that taxable event is going to be.
But do you have people who do have boot?
Oh, yeah.
Just because of how it works out?
Oh, yeah.
Okay.
Yeah.
But I have a few questions.
Okay. Well, these are off the map.
I know, these are off. You
they're
got to go
not
off.
even- okay.
That's the beauty of our podcast. I get to go off. I'm the host. I can go off script.
All right.
You stay on script. I can go off. No. All right. So I just want to use some examples here. So I like to use a 500,000. Okay. So
Okay.
you bought a property for, let's just say, 250,000.
Mhm.
10 years later, it's worth 500,000.
Okay.
And you're telling me and let's have a mortgage on it for.
The mortgage doesn't matter.
Mortgage has nothing to do with
Nothing to do with it.
Okay, so you don't get to deduct that off.
Nope.
Okay, that's the question. And then is it the price that you sell minus closing costs?
Minus non-recurring
See,
only.
this is what I.
Yeah, and these are
Great.
the minutia.
Yeah, that's what I'm talking
Yeah,
about.
that's important. And the non-recurring, the good news is the non-recurring costs of a sale are usually the most expensive ones. Your real estate commission, your state transfer taxes.
It's a one-time thing, right?
These things that happen one time that had nothing to do with an ongoing expense, as compared to, for an example, your property taxes.
Okay.
Those cannot be deducted, so whatever you paid up to the closing in property taxes doesn't count. If you had a mortgage, whatever you paid off the mortgage doesn't count.
Okay.
Mortgage is a repeating expense.
Non-recurring closing costs.
Non-recurring only, right?
Okay, that's great. What's the next question I have? So, and it's probably down here, but I want to ask it. So you can buy. You have to use 500,000. We're back to our 500, 200.
Okay.
And to get the full benefit, you got to buy something at or above 500,000.
Or multiple things.
Yes. See, you read mine. So,
Market aggregate equal to that. You could buy 3 properties that equal 500 or more.
and you can buy over it.
You can buy 10 properties if you, let's say you want to buy little rentals in
Alabama.
Ohio.
Oh, right. Oh, that's good.
Alabama's not so cheap
I know.
anymore.
Tennessee's not.
No. Okay, so I'm talking Ohio, which is still, you can buy a rental for $700,000.
Okay.
Or not for 70,000, yeah. So let's say you want to buy a bunch, okay, even though you're identifying more than 3, if you're not going over twice what you sold value, you can buy as many as you want.
Okay.
Okay, so
you can do multiple properties.
multiple properties, yeah.
Okay. That's how many have you seen in one?
The most I've seen on the buy side is he sold a commercial property in California, and he bought 17 single-family new builds.
Wow.
Yeah.
17. Okay. That's good to know. Now, can you get mortgages on those?
Uh-huh. Yeah, you can you can use the cash that you have, your 1031 proceeds, that's the cash that you earned from the
500,000.
sale of
Yep.
the relinquished property. So let's say you got money, you can put that money down and borrow the difference to buy these properties as well. But the rule is you got to spend all the money that you got in your exchange account and not have boot. But that can be a down payment and you can borrow the rest. Best example there,
Yep.
sold a property in South Lake Tahoe and bought 11 single-family homes, new builds, and he put 40% down and borrowed the difference on all of those.
Okay.
Yeah,
But
so-
you have to, as a buyer, have that all worked out. Make sure you can get all that mortgage, right? Yeah.
Well,
Because you don't want it to fall apart, obviously. but
yeah,
have
you
to-
want, and sometimes the lender is going to want you to have a written lease agreement that's at least a year in advance. Or, you gotta make sure that you have the ability to do that.
All right. I don't know. Why do they call it boot? Can they say the difference?
Because,
Yeah.
this is really obscure.
Yeah, I know.
Okay,
but
so
boot, I love it.
boot. Back in the day, when 1031 exchange was simply, I'm going to swap. You want my bottle of water? You give me your bottle of water. They had to be equal in value. And
Okay.
if I gave you anything that wasn't a bottle of water, like
Yeah.
a boot full of cash,
Okay.
that was it.
That's the story.
That's how old it is. Yeah, 1031 has been with us since 1921.
But every year, isn't it? Congress is always trying to get rid of it, right?
Well, every new administration.
There's always someone.
Every new administration, somebody thinks messing with 1031 is going to be good for them. They don't necessarily look at how good it is for the economy. They look at their coffers and want to keep more money for them. And so usually new administrations want to tamper with it. But essentially it has been the same since 1921. It's the same rule with the exception of they took out property, they inserted the word real in 2018. So for real property, so personal property no longer
Great.
is a deal.
Okay.
Yeah.
So that's good to know. Boot. A boot full of cash. Okay. So we're moving on to more controversial stuff.
I haven't been asked that question.
Halfway. Yeah, I know, right? What are the latest guidelines on using 1031 exchanges for vacation homes or properties with mixed personal investment use?
Great question. Okay, so mixed personal and investment use, like vacation homes, those procedures were published in 2008. And what has happened is your vacation home has to have a rental history. So let's say I've got a vacation home and I haven't rented it out. They're going to actually specifically want a rental history for 2 years and some history for 12 months in each of that 2-year period. And specifically, it's at least 14 days in the 12 months and another 14 days in the second 12 months. And that will qualify it for 1031. If you're selling something else on a 1031 and you want to buy a vacation home, you just flip the rule. Okay, yes. This vacation home, I need to rent it out at least 14 days a year.
Okay.
And another 14 days the second year. The little hidden caveat, I know the government is, they are who they are, okay, you can't use it personally more than 14 days a year. in those 2-year periods. Now, if you do, there's another rule that kicks in, but I don't want to go there because I see we have a whole bunch to go through here, and I'm getting concerned. Yeah.
All right.
Okay.
But you can take a house that's an investment property and buy a top. But you got to know all the rules. Let's just put it there.
This is what I tell people. Well, I don't want another investment property. Would you like another vacation home? Yeah, I'd like one in Hawaii. Okay. Nationwide, I could sell anywhere, buy anywhere.
Okay.
So then you buy a vacation home in Hawaii, you rent it out for 2 years, at least 14 days, each 12-month period. And then after that, you can do what you want with that.
Man, crazy.
That's not a taxable event, except if you sell it, then there's some tax. But if you want to use it as your second dream home, more power to you.
All right, we're halfway through. So we're not that bad.
What time is it?
I don't know. Do you have another appointment?
I do.
What time?
Well, I'm at 1 o'clock.
All right, we got time.
Okay. I gotta be there by 12:30.
The battery's gonna run out long before that.
Okay.
Okay. I don't have my watch on, so this is good. We'll hurry through here. So, how do 1031 exchanges work, and the potential benefits and challenges compared to traditional exchanges? Is that even a topic we should go into?
No, because there is only one kind of, real property exchange is governed under Section 1031 of the tax code.
Okay.
So yeah, you can do other exchanges of other things, but they don't pertain to real property. So I don't have those answers.
Okay. So this is one that we already answered, but I'll just reiterate it. We're kind of going off script, my fault. But it happens. I'm a curious individual. What role does the QI or Qualified Intermediary play in the exchange process? And how has the involvement changed recently?
Right. So the change of the QI involvement happened in 1991. And in 1991, the government, under their new Treasury regulations for 91, basically said, use a QI, a qualified intermediary, or we will closely scrutinize your transaction. Which, the translation is, let's invite an audit. Okay, so you don't want an audit, so on a 1031 exchange, you want an intermediary involved, and the intermediary is what protects the investor from the taxable event.
Okay.
Yeah, I just want to point out, we have to be engaged before it closes escrow.
Yeah.
And then we have to move the money on behalf of the exchanger. We have to deposit the money into the buy side or buy sides, however many there are, on behalf of the exchanger. And then at the end of that period, if there's anything left, we send it back to the exchanger.
Okay.
Okay.
Keep in mind that Kandas and I both agree on one thing, is if you are selling a 1031 exchange, you probably should let any buyers, we're not going to go into why, but any buyers know that you're doing a 1031, or if you're going reverse, correct?
I say, you know what? I don't think they need to know until you go under contract.
Okay.
So once you're under contract, and most contracts have a clause about, hey, if a 1031's being done, everybody's going to cooperate.
It's in our contract, so just keep that in mind. That
it's in there. So and a lot of times the lender, they want to see the 1031 language. Sometimes they'll say, show me the addendum. Sometimes let's say the exchanger's buying something and they're going to get a loan. They want to see the 1031 language from the original property that was sold. So it's not just smart. Yeah.
But just disclose it. It's the best thing to do. All right, so now we're knocking all these out. 10's easy. What are the fees for facility and 1031 exchange? Are there any hidden costs? You said your company does what?
The one thing, our company is $11.95.
Okay.
And the thing I love about it, there's no hidden anything in there. There's no additional fees, for setting up the stuff. And that's for a regular, what we call forward exchange. You're selling a property, you're buying properties. Okay, so the buy sides, some companies charge you more if you have more buy sides.
Okay.
We do not.
Okay.
Okay, we might have to charge more. Let's say you have, because I had one this week, 2 sale sides into 1 buy side. The 2 sale sides need to be closing within 45 days of each other. Otherwise, we have a document issue. And so, the sale side, multiple sale sides are a little different than multiple buy sides. Right now, $11.95 is going to cover it.
Okay.
So.
And then what's the industry standard? Is in that I've always been told 1,000 to 1,500, right?
You know what?
Approximately.
It depends on who you. I've worked for 2 other companies in the past.
Yeah.
And they were allowed to set their own costs. So the result was, if you called one number for XYZ exchange intermediary, you got one. And if you called this other number, you got a different price. So the pricing was very confusing, and we just set the price. And yes, the industry standard is somewhere up towards 1,000, about 800, maybe 850, up to, I've seen ones that are 15,
Okay.
2,000.
But you can shop around, right? Just type in.
You can, yeah, you can shop, but like anything,
Get what you pay for.
you're getting what you pay for. I remember back in the day, I don't even know if they're still around, but there was some company doing it for $320.
Well, that's just like
Yeah,
anything.
and what happened was the exchanger went with that company, and then a few months later called me up and said, I can't get them to answer the phone. And then when I did get them to answer the phone, they didn't know the answer. So can you help me, Candace? And that's part of the, in some cases, you're going to be helpful, and in others, it's like, you were really rude to me. I'm sorry, but I'll send you a
shop
recipe
around. But I think you need to interview some people, right? Make sure they have the experience.
You want to, yeah.
They're the person that's going to help you,
Plus,
and your agent and everyone.
Yeah.
Get you through the.
Most people don't even ask, how are you holding the money? That's the most important part.
Right.
In addition to experience, is how are you holding my money? And
okay.
Anyway.
We already talked about the new strategies for identifying replacement properties, so we kind of a lot of these you were worried. The one thing I want to ask real quick is, so when you do a 1031 exchange, let's just say you've owned the property for 10 years.
Mm-hmm.
You have the capital gains, so we're at the
Right.
250, 500, but to be clear, you're also deferring the depreciation, right?
Depreciation recapture. Yeah.
Okay. And now let's just say you buy a more expensive property. You buy it $250. Your depreciation was like, let's just say $10,000 a year for depreciation. You move to a bigger property. Do you get the stepped up depreciation on?
Mm-hmm. You get the difference between the depreciation you transferred over and the new depreciable base of what you bought. Okay. Which is why many of your 1031 practitioners in the investment world will buy up in value.
Okay, because you get that.
Yeah, it's not a given that you have to, because you're still going to defer tax if you go even.
Okay.
But a lot of people will go up in value to get more depreciation base.
Do we even want to talk about Delaware statute and real estate investment trust?
Nah.
No. Well, so we're going to do a 2.0.
Yes, we are.
So, because there's some very complex stuff where you don't
That's
have
right.
to buy necessarily. You can buy in these trusts and real estate REITs.
Right.
So that'll make you come back and watch the video. So, what are the most common mistakes, and how do we avoid them?
Oh goodness. Okay.
What's the top 4 or 5? Because I know I had one that she bought a new build, and then the new builder had some problems financially and couldn't finish the close, so
right.
She did not.
Yes.
Was unable to do that. So that's something that you be careful when you're.
Yes, and I have had that happen, but that is very rare.
Okay.
Good. That where the builder was not able to finish the property in the 180-day window. The other one with a new builder that was just dreadful is she identified the property that was going to be built, but then by the time they got closer to,
they moved the date back.
No, that they were building the property built. They were on time to close it within the 180 days, but then they changed their rules. Oh, sorry, we're going to go. You can't have a rental here. And it was past the 45th day.
Okay.
So she ended up with a taxable event, that is very uncommon. Okay, I don't want to say that's a common thing. The most common mistake that people make is not identifying in the 45-day window. Okay. That is written in stone. The second most common mistake is closing escrow without the intermediary involved with the escrow.
At the end saying, hey, can I use a 1031? I said, have you closed? Yes.
Yeah.
It's
if
too
you've
late.
Closed escrow on what you're buying or selling, it's too late. You can't use a 1031 exchange because you have to have the intermediary engage. The paper trail is different.
Okay. So, even if the title company just keeps the money?
The title company keeping money that money's under your control. Okay, so the exchanger has access to the funds. It's called constructive receipt.
Wow.
Yeah.
See, this is awesome.
Yeah. All right. Okay. He's going to be the expert now.
So we have one last. How does the 1031, and we'll probably answer this, but we're going to ask it. How does the 1031 exchange affect the investor's tax situation in the short term and long term?
Okay, so obviously in the short term, the 1031 is keeping the equity intact.
Okay.
So the equity gets to move to purchase another property without a tax bite.
Okay.
So that's the short term. Okay, in the long term, that equity, depending on what you're doing with it, if you're going straight across with that equity, it's going to be, pretty much working for you in an equal kind of manner. However, if I use that money as a down payment, and let's say I get a 25% loan to value on something, well, now if I spread all that money out and it's 25%,
multiple properties,
and I have leveraged it up to 75, okay, so now I've leveraged my 25% into a property that's worth 75% more, right? Now I'm earning on my appreciation or whatever cash flow I'm getting. The leveraging up in the long term is extremely powerful.
Okay. Yeah. And then you get to put off depreciation recapture. You
get to put off, and I always tell people, you never have to sell. The adage is swap till you drop. And then once they take you out in a box, then
you get the stepped up cost basis.
You get the stepped up basis, which means your beneficiaries inherit the property with no tax.
Yeah, and that's why a lot of people, once they get past 15 years, they don't ever sell because they'll have the tax consequences.
A lot of the smart investors don't sell. Another thing, you can refinance. That's not a taxable event. If I need cash, I can refinance something that I have. So 1031s are extraordinarily powerful for investment portfolios and for estate planning.
So last question. So because if we're talking residential, 27 and a half years is the depreciation schedule, correct?
27 and a half years.
I don't know why. Why is it half?
Well, I don't know. But
can they do 30?
On residential, the depreciation, the number of years you get to depreciate it is a 27 and a half.
So question is, let's just say that you are at 25, you do a 1031 exchange. Does that reset that 27 and a half?
No.
So you just keep going with the stepped up amount to 27 and a half, and then after that you don't get any more depreciation?
Only if you've bought up in value, then you have some additional depreciable base.
Okay, yeah, you get the additional.
But if you went straight across in value, then your depreciation stayed the same.
Right, but you don't, even if you do a 1031 exchange at 27 and a half years, that's the deadline where you don't get any more after that, correct?
Right, and that's a good reason to be exchanging, is to sell it and buy something of higher value.
To take advantage
so that
of that.
You get,
Okay.
Yeah.
All right, well, we're not going to give away all of the secrets here, but what's your number? She's looking for her phone already. But
no, I know, I've started to move the mouse.
Tell them your number, how do they contact you, the right email?
Yeah, I know. So let's do the email first. Kandas at 1031 Specialists, and there's an S on the end. And then my cell phone number, they gave me a new one with my new company that I have. So let me see if I can remember it. It's 775-993-988.
Uh-oh. That's all right. So what we'll do...
Yeah, you know what? Let me give you this one because I know this one still works. 775-710-9119.
So we're going to put all your information below.
Well,
so you can click on it and get to it. We'll put your website.
I'll give you the right. I should have brought my new card.
And then call her. We have several clients. I think we have like 4 clients doing 1031s.
Awesome.
But you want to get something that's knowledgeable because they're the one that's going to hold your hand. Because in these deals, what I can tell you is there's always something a little weird nuance that has to be massaged out to make. What is the saying you have?
Mm-hmm. Swap till you drop?
No, quack.
Has to look, walk, and quack.
Yeah, because you want to make sure you follow the rules to take advantage of it.
The smallest change can kick it out of the look, walk, and quack category, which is, for an example, changing the ownership right before an exchange. Oh, I added my son. Oh, I took my son off. These things can make it not look, walk, and quack the best way it could.
Okay.
Yeah.
So, and these are things that you should probably find out ahead of time before you start thinking about one of these. Just
Yeah.
ask the questions. So. All right.
Thank you, Ken.
Yeah, thank you.
That's
You're
awesome.
We're gonna do 2.0 because there's reverse.
Reverse exchanges and improvement exchanges.
I want to know about improvement exchanges.
Yeah.
That's what I don't know about. And we'll do a round 2 on that. Call Kandas. Otherwise, like our video, give us thumbs up, and share this with another investor because this is a very powerful way to create wealth, right?
And thank you, Ken, for inviting me.
Yeah,
It
she was like
fun.
on it.
It was so fun.
We just did a class. I just took her class, and I'm like, we got to do a podcast on this. So.
Awesome.
All right, until next time, you guys take care, and we'll talk to you soon. Thanks.
Bye.